there was a strategist of Double Line, which is a fund management company, and he said that the Fed suddenly will have to cut interest rates, not by 0.25%, but by 1%.
Wow.
And in rapid succession, because the economy will deteriorate so much. When that happens, the dollar will tumble, and gold and silver and platinum will go ballistic.
Dr. Marc Faber, editor and publisher of Gloom Boom and Doom report, believes that the Fed might need to cut interest rates by a lot to stimulate the economy. This could cause the value of the US dollar to drop and the price of gold and silver to rise. John C. Williams, the president of the Federal Reserve Bank of New York, thinks that the central bank's push to cool the economy is near its peak and that he expects that interest rates could begin to come down next year. The upshot is that interest rates are unlikely to rise much further than the current range of 5.25 to 5.5%. Fed officials could also consider cutting them soon. Faber thinks that if interest rates keep going up a lot, it could cause problems because most people would have less money to spend, and this could make prices go down because businesses need to make things cheaper to get people to buy them. Even after raising interest rates to the highest since 2001, the Federal Reserve still isn't ready to call it quits on its fiercest inflation fight in 4 decades. But the higher rates climb, the harder the decision becomes. Policymakers on the rate-setting Federal Open Market Committee raised interest rates another quarter point in July to a new target range of 5.25 to 5.5%, a decision that marks the 11th increase in 12 meetings. Let's watch snippets from Steve Hanks' interview, but before getting into the video, make sure to subscribe our channel and give this video a thumbs up.
It looks as if finally interest rates begin to have a mild impact on asset prices, because as interest rates rose, the rate of inflation came down somewhat, the rate of price increases.
Right.
Has nothing to do with monetary policy, that's just to do with a demand destruction. As prices went up, households had to cut down on their expenditures. And so it is possible that from now on, the interest rates may hurt business somewhat. But the impact on precious metals, I would describe as follows. In my view, the Fed will one day overdo its interest rate increases, because as I just described, say in a population, you have 0.1% of super rich people. They benefit from the mild interest rate increases we had in real terms. The wide public, say 80% of the population, is hurt by rising interest rates because they have net debts.
Right.
And most companies have net debts. Some companies have net cash. They benefit from rising interest rates, but the net debtors, they are hurt. So at some point, the majority of households have a problem in their spending patterns because the purchasing power of the money they earn is going down. So they cut down on spending, and that will have then the impact to destroy demand. And then prices tend to ease.
When the government spends more money than it gets from taxes, it has to borrow money to make up the difference. This creates something called a deficit, which is like a gap between what's spent and what's earned. Every year, if the government keeps spending more than it earns, these deficits add up and create a big overall debt that the country owes. In the past, the biggest deficits happened when the government spent a lot of money during major emergencies like big wars or when the economy was in really bad shape like during the Great Depression. Right now, the coronavirus crisis has made things even worse because it hurt the economy a lot, and the government had to spend a lot of money to respond and help people. Faber highlights that the government has borrowed a lot of money. Instead of being smart and borrowing when interest rates were low, they borrowed when rates were already going up. This is causing them to pay a lot more in interest, which is a big problem. Let's watch Marc Faber's interview with Wall Street Silver.
Don't ever believe anything that comes from a government official.
Yeah.
That's rule number one. But of course, the Fed, in order to maintain some degree of credibility, most of their credibility has been lost already.
Yeah.
But to maintain some credibility, they have to increase rates to a level where they can pretend that they're actually fighting inflation. It's not very clear how they fight inflation, because inflation can occur in building prices like the home prices, or it can occur in commodities, or it can occur in stocks, or in bonds, or in wages. So far, what the increase in interest rates has done is to reward wealthy people to some extent, including myself. You take my portfolio, which has maybe 15-20% of its money in cash. 2 years ago, I didn't get anything on my cash, and now I can place money for 1 year at over 6% interest.
Yeah.
So some people have actually benefited from the increase in interest rates, and the people that are hurt are the people that are poor and therefore have large credit card balances. They have large home loans, mortgages, student loans, consumer loans, and so forth. And all these loans, the cost of these loans has all gone up meaningfully, not little.
Yeah.
And number two, that is good. The one that is hurting in the long run the most is the government, because they have huge debts. And whereas a clever treasurer of a company, when interest rates were artificially low, would have borrowed at, say, 1-2% for 30 years, Miss Janet Yellen, the Secretary of the Treasury, continued to borrow short-term in 2020, 2021, when interest rates were lower than ever in the history of the United States. So it shows what the skill is of these government officials. It's a complete disaster. But that we've known, whatever the government does is worse than what the private sector does. It's nothing new. But what I want to say is that now the interest on the government debt in the US is exploding.
Yeah.
And it will continue to go up. By next year, I think it will be over $1 trillion, the interest alone on the debt. Also in Japan, that the US is not unique in that respect. All the governments are in the same position. But what I want to show is some people benefit from rising interest rates and others are hurt. You could have interest rates at 2%, and if you have no inflation at all or deflation, it's tight monetary policy.
What do you think the impact of the Fed cutting interest rates would be on the economy and prices of gold and silver? Would it be a good or bad thing? Let us know in the comments below. That's all from us. If you like this video, please like, share, and subscribe to our channel and click the bell icon to be notified when we release new videos. Currently, 95% of our viewers have not subscribed to our channel. Our next goal is to reach 2,000 subscribers. Please consider subscribing to our channel and helping us reach our target.